All right, let's talk about one of the simplest, most misunderstood, and yet most powerful concepts in all of Forex trading, moving averages. If you've ever opened a chart and seen those smooth lines gliding across the candles, you've probably wondered, what exactly do they tell us? Are they just decorative? Or are they the secret weapon used by every serious trader from London to Tokyo? By the end of this video, you'll understand exactly how moving averages work, how the world's biggest traders use them, and how to turn them into a complete trading strategy that could change the way you look at charts forever. Let's begin. Moving averages are like the heartbeat of the market. They don't predict the future, they reveal the rhythm of price action. When price is above a moving average, the heartbeat is strong. Buyers are in control. When it's below, momentum weakens, sellers take over. But the beauty is in their simplicity. A moving average takes the average price of the last X periods, maybe 20, 50, or 200, and smooths out the noise. It filters chaos into clarity. There are two main types, the simple moving average, or SMA, and the exponential moving average, or EMA. The simple moving average is the classic version. Every candle counts equally. The exponential moving average, on the other hand, gives more weight to recent data. It's faster, more sensitive, and often more responsive to trend changes. Think of it this way. The SMA is the wise old investor, patient and calm. The EMA is the young trader, alert and reactive. Now, why do traders use moving averages? Because they define trend direction. They act as dynamic support and resistance. They help identify momentum shifts. And when combined, they generate some of the most famous signals in trading history, like the golden cross and the death cross. Let's decode those. A golden cross happens when the 50-day moving average crosses above the 200-day moving average. It's the market's way of saying, the bulls are back. A death cross is the opposite. The 50 drops below the 200. It whispers, the bears are in control. But here's the catch, these signals alone don't guarantee profits. Markets are noisy. Moving averages lag. By the time a crossover happens, price might have already made its big move. So the real edge isn't in blindly following the lines. It's in understanding what they represent, the psychology of traders reacting to momentum, fear, and greed. Imagine you're looking at euro to US dollar. You see price bouncing off the 200 EMA 3 times in a row. Each time, buyers defend that level. That's not just a line, that's institutional support. Banks, funds, and algorithms are likely stepping in. Now, if you combine that observation with volume, price structure, and perhaps a bullish divergence on RSI, suddenly, the moving average becomes your confirmation tool, not your compass. So let's go deeper. How can you use them strategically? One of the most powerful setups is the moving average confluence strategy. You use two EMAs, say a 20 and a 50. When both slope upward and price pulls back toward them, that's your buy zone. When they slope downward and price rallies into them, that's your sell zone. You're not predicting the future. You're reacting to alignment. Momentum and structure and harmony, that's where traders win. Another advanced technique, the moving average cloud. Plot multiple EMAs, 20, 50, 100, 200. When they fan out in one direction, the market is trending. When they coil together, expect a breakout. It's like watching a storm form on the horizon. The tighter the cloud, the bigger the move that follows. But here's something most traders miss. Moving averages also work on multi-timeframe confirmation. For instance, if the daily 200 EMA is trending up, but on the 1-hour chart you're getting a pullback to the 50 EMA, that's a textbook long setup. You're trading in the direction of the larger trend while catching shorter-term entries. This is how professional traders ride waves. They align the tide, higher time frame, with the ripple, lower time frame. Let's break this into a full system you can test. Step 1. Identify the dominant trend using the 200 EMA on the 4-hour or daily chart. If price is above, bias long. If below, bias short. Step 2. Drop to the 1-hour chart. Use the 20 and 50 EMA. Wait for a pullback to these lines in the direction of the trend. Step 3. Confirm with structure. Look for a higher low in an uptrend or lower high in a downtrend. Step 4. Wait for a candle close confirming rejection of the EMAs. Step 5. Manage risk. Place stops beyond structure. Target the last swing high or low and trail behind the 50 EMA. That's it. Simple, systematic, and surprisingly effective. Now let's talk about why moving averages actually work, not just mechanically, but psychologically. They work because traders believe in them. They act as self-fulfilling prophecies. When thousands of traders watch the 200 EMA and place buy orders near it, it becomes a magnet. The market literally reacts because everyone expects it to. It's crowd behavior visualized on a chart. And this is where confluence is everything. A moving average alone is like one voice in a crowd. But when it aligns with support zones, Fibonacci levels, or key psychological prices, that's when the crowd starts chanting in unison. Now let's uncover a few advanced applications used by institutional traders. First, EMA compression and expansion. When EMAs of different lengths converge tightly, volatility is low, but tension is high. When they start expanding apart, volatility is returning, momentum is building. This transition phase often precedes major breakouts. Second, EMA sweeps. Price often wicks below an EMA to trigger stop losses, then reverses hard. Smart money uses these fakeouts to trap retail traders. If you see a sharp move below the 50 EMA followed by a strong engulfing candle back above it, that's not weakness. That's a liquidity grab. Third, EMA stacking and momentum zones. When shorter EMAs are above longer ones, 10 greater than 20 greater than 50 greater than 100 greater than 200, the trend is strong. When they flatten or cross, momentum is fading. This technique works beautifully in trending markets like pound sterling to Japanese yen or US dollar to Canadian dollar, where momentum tends to persist. Now let's address one of the biggest mistakes traders make with moving averages, using too many. It's easy to clutter your chart with 5, 10, 20 lines, but simplicity is power. Focus on the few that align with your time frame and trading style. Day traders, the 9 and 21 EMA combo is lightning fast. Swing traders, the 20 and 50. Position traders, the 50 and 200. Each has its rhythm. Find yours. And remember, moving averages are not crystal balls. They don't predict reversals. They confirm them. Use them with price action, volume, and market context. Let's take a real-world scenario. You're watching pound sterling to US dollar. Price has been trending higher for weeks, above the 200 EMA. Suddenly, it pulls back to the 50 EMA, consolidates for 2 days, and prints a bullish engulfing candle. That's your cue. Buy the pullback, ride the wave. Now let's flip it. US dollar to Japanese yen has been falling sharply. You see a retracement back into the 20 EMA, forming lower highs. Price rejects it, prints a shooting star. That's your sell trigger. See the rhythm? It's not about predicting tops and bottoms. It's about catching the middle, where the big money flows. Because pros don't buy bottoms or sell tops. They trade momentum. And moving averages are momentum visualized. Let's touch on risk management. The most successful traders never rely on one indicator. They use moving averages as confirmation, not justification. Your moving average might say buy, but if volatility spikes or fundamentals shift, step aside. Discipline beats indicators every time. Now let's talk about backtesting. Every trader thinks their strategy works until they test it. Go back over charts, mark every EMA setup for the past 6 months. Record results, average returns, drawdowns. You'll be shocked how quickly your perception changes once data replaces emotion. And here's the thing, moving averages still work because human psychology hasn't changed. Fear and greed still drive markets. Algorithms still respond to trend behavior. Institutions still watch the same levels retail traders do, just with bigger size. The 200 EMA on euro to US dollar means the same today as it did 20 years ago. It's not magic. It's consistency. So as we wrap this up, remember, moving averages are not about predicting the future. They're about syncing with a market's heartbeat. When you learn to listen, really listen, you'll notice that price moves in waves. The EMAs trace those waves, helping you stay on the right side of momentum. Because in Forex, the goal isn't to be right, it's to be aligned. Stay disciplined, stay patient, and let the averages guide you, not define you. And if you want to dive deeper into mastering Forex trading, I'll link a full step-by-step course in the description and pinned comment. It's the most comprehensive guide you'll find, and it'll show you how professional traders use tools like moving averages, Fibonacci, and fundamentals to dominate the markets. Now hit that like button if this helped you see charts differently, subscribe for more deep dive videos, and as always, trade smart, stay consistent, and I'll see you in the next one.